valuation. Valuation of securities. So first of all, we start with the valuation of businesses using various models. And we are looking at this question on Zora Limited, which is a financial management question applicable also to advanced financial management. Yeah, August 2023, question number 4C. I had already done part 1 and part 2. Would you want us to repeat 1 and 2, or would you want us just to continue with 3? Can we repeat pretty first? Can we repeat pretty first? Yeah, I think so, for purpose of just a recap. Yeah, it's important, and the connection, of course, with what we shall be doing today. So you're told here, Zora Limited, a securities market listed company, has the following recent financial information. So we have the profit after tax that has been given for Zora. Dividends has been given. Then we have been given statement of financial position. Yeah, statement of financial position. This is provided. This is provided, yeah. So I can see additional information. Financial analysts have forecast that the dividend of the company will grow in the future at a rate of 4% per year. This is slightly less than the forecast growth rate of the profit after tax of the company, which is 5% per year. Note 2, considering the risk associated with the expected earnings growth, earnings yield of 11% per annum can be used for valuation purposes. So considering the risk associated with the expected earnings growth, earnings yield of 11% per annum can be used for valuing the business. Zora Limited has a cost of equity of 10% per annum and a before tax cost of debt of 7% per annum. Very good. The 8% bond will be redeemed at par in 6 years' time, and the company pays tax at an annual rate of 30%. The ex-dividend market share price of Zora is 8.5 per share. So they want us to calculate the value of Zora Limited using the following bases. So we start with net asset value, yeah, and then we do dividend, and then we do earnings yield method. Great. So ladies and gentlemen, when you hear about net assets value, NAV, and it came last semester, what in this case here normally comes to our mind? Whenever they talk of net assets value, this is what we shall always be thinking about. NAV. NAV is basically total equity. How do we get NAV, net asset value? We'll normally take total assets. We subtract all liabilities. Total liabilities. And in the case, remember, total liabilities including preference shares. Including preference shares. Remember the current trend in finance? Preference share capital is normally taken to be part of liability. Preference share capital is normally taken to be part of what here? To be part of liability. Why? Remember the preference shareholders, regardless of whether you are making a profit or a loss, they must always, in this case here, be paid. Even if you make a loss today, preference shareholders will always be what here? Will always be paid. So basically, preference share capital holds what we call a fixed rate of return, just like a loan. Yeah. So in short, what we are saying, ladies and gentlemen, is that whenever they want us to give them NAV, we shall take total assets. We subtract, in this case here, current liabilities. We subtract non-current liabilities. And then we subtract any preference share capital, like that. So for this great organization of ours, is there somebody who is able to see those assets? Look at the balance sheet given. So the balance sheet given, what is it giving us, my good students here? The balance sheet that is given here They have told us, if you look at this very well, ladies and gentlemen, we can see non-current assets. We can see current assets, and they have given us total assets here of 1,080,000. So total assets here are 1,080,000. Yeah, minus current liabilities, look for them. You can see our liabilities. Yeah. So you can see we have equity here, and then we have non-current liabilities, of which you are able to see what here? We are able to see a bank loan and some bonds there. Yeah, giving us what here? Giving us 240,000. Giving us 240,000 there. Giving us 240,000. And then we have current liabilities up here. Yeah, quite confusing. You know, a normal balance sheet, current liability should come down here, right? So we have here current liabilities of 105,000. So minus 105,000 current liabilities. And then the non-current liabilities down there, we can see they are totaling to, they are 240,000. So minus 240,000. This question does not have any preference share capital. So is there somebody who is able to give us this net assets value? Anybody who is able to give us this net assets value? Anybody who is able to give us this net assets value? So then that is the amount that I'll be willing to pay to acquire Zora Limited. So to acquire Zora Limited, I'll be willing to pay a maximum amount which is equivalent to its net assets value. Preference share capital is not given in this question, but we have to maintain it in the formula. So somebody is giving us a figure of 735,000. 735,000. So are we together, ladies and gentlemen? Have you been able to follow something there? Net assets value. You take total assets minus all liabilities. Thank you so much. Now from there, ladies and gentlemen, we go to the next concept. So the next concept here is what they are calling number 2, dividend growth model. Number 2, dividend growth model. So number 2, we have the dividend growth model. That in this case here, good organizations shall be able to, give us returns. We as the buyers of the company, we as the buyers of their ordinary shares, they should be able to give us returns. And those returns will be known as what here? The dividends. So those returns, we are assuming that we shall get them indefinitely. You guys are great finance scholars. Let me ask you a question. Assuming in this case here, somebody promises you 10 million Kenyan shillings per annum, and the R is 10%, where N is infinity. Can somebody give me the present value of this cash flow? Yeah, somebody will be giving you 10 million every year. N is infinity. The cost of capital, in this case, here has been given as what here? The cost of capital has been given as 10%. Can somebody in this case here give me the present value of this value? Present value of this value, of this cash flow. Chris is getting 1. I don't know what it did to get 1. Or it took 10 divided by 10. Chris, remember the cost of capital is 10%. 10% is the same as 0.1. But at least Chris is able to see very well here that my present value will be equal to the cash flow amount, divided by the cost of capital. Anytime we have a perpetual cash flow, a cash flow without an end in sight, we shall always take the amount we divide by R. So in that case here, we shall take 10, we divide by R. R is the cost of capital, which is 0.1. That's why you can see that Ninja there is getting 100 million. Yeah, 100, something like that. Thank you very much. Ladies and gentlemen, the same is applicable to value of a company or even value of a share. In terms of dividend, remember we use dividend growth to value shares. So if somebody tells me to value a share, yeah, remember we are assuming that we shall stay with this company forever. So normally what we shall do is to take the expected dividend, which we discount. Yeah, we discount this by what here? By the cost of equity. We take the expected dividend And because we shall be receiving this without an end in sight, so I will take this DO, I divide by KE. Yeah, but now remember, ladies and gentlemen, that this DO, unlike the other one that I gave you, there is growth. You can't get an organization whose dividends do not grow. So you expect dividends to grow. So in this case, you must come always here and there, include the growth. So 1 plus the growth rate. And then the growth rate must always be deducted from down here. This is what we call the dividend valuation model. We use it to value ordinary shares and we use it to value companies, where this PO stands for market price per share. Actually current, include the word current because of the O. The current market price per share. The current market price per share. And then DO stands for current dividends per share. Current dividends per share. All right. And then we have in this case here KE standing for cost of what here? Cost of equity. KE stands for cost of equity. Cost of equity. And then G, in this case here, stands for growth rate. Growth rate of dividends. Growth rate of dividends. Growth rate of dividends. Growth rate of dividends. And if you remember very well, this is what Mwalimu always keeps on calling the 𝐘𝐮𝐬𝐴's model. Remember 𝐘𝐻𝐵? If you remember 𝐘𝐻𝐵 here used to talk about a company of shares, all right, dividends, shareholding. And remember this gentleman some time back was a DO. Yeah, so in this case, 𝐘𝐻𝐵's model, a DO who grew in ranks. Yeah, he never actually became a provincial officer. This guy was able to become a deputy president right away, MP, deputy president, etc. Yeah, and of course, if you mess up with him, this guy knows how to speak very well. And I'm not political. I'm only trying to bring this in a way that you'll be able to remember this forever. So if you mess up with him politically, then it will be Kenya without government. Kenya without government. 𝐘𝐻𝐵's model, very, very important model that I shall be using in this case here throughout when we do our finance. All right. So when it comes to valuing one share, we shall be using this formula, one share. But you see here, we are being called upon to value an organization. Here we are being called upon to value an organization called 𝐨𝐼R𝐟. Called 𝐨𝐼R𝐟. You see here, they want us to value dividend growth model. You value 𝐨𝐼R𝐟 Limited. You value 𝐨𝐼R𝐟 Limited. Fortunately, they have given us the total dividends. So if it is for the total organization, then this is what we shall do. So for the total organization, this is what we shall do. For the total organization, ladies and gentlemen, this is what we shall do. So for the total organization, so in this case here, farm value using dividend valuation model. So now here we use total dividends from the whole organization, which will grow all over cost of equity minus what here? Minus growth rate. So the only difference is that now here we are not talking about just one share. We are talking of farm value. It will be total dividends into 1 plus G. Yeah, 1 plus G. In this case here, divided by cost of equity minus our growth rate. So then, is there somebody who is able to see the total dividends in the organization? Total dividends in the farm? Oh, yes, they're given here. Total dividends, 60,000. Total dividends, 60,000. So it will be 60,000 into 1 plus G, the growth rate of dividends, not growth rate of profits. No. You can see finance analysts here have forecast that the dividend of the company will grow in the future at 4%. Yeah, and then profit will be growing at 5%. Here we want the growth rate of dividends, 4%. Growth rate of dividends, 4%. And then now we look for cost of equity. So has the cost of equity been given in this question? Oh, yes. The cost of equity is provided. The cost of equity, ladies and gentlemen, is given here. Cost of equity is given here. We are told the 𝐷𝗧𝗏 Limited has a cost of equity of 10%. Cost of equity of 10%. Cost of equity of 10%. So this will be 0.1. You see, 10% is the same as 0.1. So 0.1 minus our growth rate of 0.04, like that. So now here you move slowly, you move very slowly. You say 60,000 times, open brackets, 1 plus 0.04, you close brackets. You say divided by, then the denominator, you must open brackets for the denominator because it has many terms, and all these terms we want to put them in brackets here. So open brackets, then you say 0.1 minus this, you close brackets, you say equals. Yeah, or you go slowly even by getting the numerator separately and the denominator separately, and then you'll be able to do what here? Yeah, thanks, Mohammed. Then you'll be able to give us an answer here. What answer are we getting, somebody here? 60,000 times 1.04 all over, open brackets, 0.1. So 1040,000 is the value of Zora using dividend valuation model. So if you're a buyer of this firm, you can't give more than this. You can't give more than this. And this is something that is very applicable practically outside here. You'll simply look at the financial statements of an entity, take like an average, like for the last 5 years, how much dividends have they been paying? What is the cost of equity? From this dividend pattern, I'll be able to calculate the growth rate and then project forever. Yeah, and then I'll be able to use this to get the value of an organization, and I can't pay a penny more than that. More than that. All right. So with your permission, I'll be able to now move on to number 3. So number 3, ladies and gentlemen, they want us now to use what they are calling dividend. No, earnings yield method. Earnings yield method. So number 3, they want me to use earnings yield method. Earnings yield method. So is there, first of all, any student here who is able to give me the formula of getting earnings yield, given that you guys are experts? How do we get earnings yield? Anything called yield, whenever you hear yield in finance, know that the denominator is market price per share. Anytime they talk of yield, know that the denominator is market price per share. Now, ladies and gentlemen, earnings yield will be earnings per share all over market price per share. So whenever you hear about earnings yield, anything yield, yeah, please remember, just remember here as well, recall. So recall, when they want us, for example, to give them dividends yield, yeah, it has to be something at the top all over MPS. So these will be dividends per share. Don't forget that. Don't forget that. And now, because they want us to use this method to be able to value an organization, make MPS the subject of the formula. So make MPS the subject of the formula. So when we cross multiply, so this will be earnings yield times MPS equals EPS. Therefore, MPS will be equal to EPS over EY. Yeah, and of course, earnings will be growing. So because of the growth rate, when G is given, if growth rate is given, then my market price per share will be equal to EPS into 1 plus growth rate all over earnings yield minus growth rate. Earnings yield minus growth rate. If growth rate is given, if G is given, I should have written here, if G is given, then MPS will be equal to EPS into 1 plus growth rate all over EY minus growth rate. So you see, this is one share, this is value over a share. Yeah. So what if they want me to give them farm value? Farm value, total farm value. So in this case here, for me to be able to get the total farm value, total farm value using earnings yield method. Then I will take, in this case here, total earnings, which are profits after tax. Total earnings are profits after tax into 1 plus G all over earnings yield minus G, like that. So remember, PAT represents total earnings from the organization here. And this is what they wanted us to do, to give them total farm value of Zora using earnings yield. All right. So using earnings yield, ladies and gentlemen, then what will be the farm value? All right. So then we just need to go to the income statement of Zora Limited. We are professionals now. So in this case here, Zora Limited. So Zora Limited, you'll be able to see profit after tax earnings, 99,900 into 1 plus growth rate. Remember, now it is the profits growth rate. It's not dividends here that are growing. It is the earnings growth rate. Yeah. If you read number 1 here, financial analysts are forecast that the dividends of the company will grow in the future at a rate of 4%, that is dividends. This is likely less than the forecast growth rate of the profit after tax earnings of the company, which is 5%. So you can see profit after tax is growing at 5%. Whenever we mark these papers, we normally see students making slight mistakes. Students are very bright, but at times they make very, very slight mistakes. These are profits, so this can only be growth rate of profits, which is 0.05. All over EY, please write it somewhere there. It stands for earnings yield. That will be provided. But if you get a bad examiner, I can't give it to you. If you get a bad examiner, we can't give it to you. No. You can see you're considering the risk associated with the expected earnings growth. Earnings yield is 11%. These are lazy examiner. A good examiner cannot. He would want you to calculate it. So earnings yield, in this case here, is 0.11. Yeah, minus the growth rate, which is 0.05, like that. So can you then kindly go ahead and give me the final answer? Always, whenever you have many numbers in the denominator, get used to putting them in the brackets. So if I'm the one who was setting this paper, what I would have done, I would have given you EPS and I would have given you DPS. Yes. I would have told you, listen, and MPS. I would have told you, ladies and gentlemen, that the EPS is 11, DPS is 10, yeah, and then MPS is 100. That's what I would have told you. And then ask you to value Zora using earnings yield method. That shows creativity from the examiner's side. Yeah, and then of course now a better student in terms of creativity now will be able to come and say, hey, to get earnings yield, I know it is earnings per share all over what year? MPS, because you're yielding to your market price. Earnings yield, it's EPS over MPS. So this student here would have easily calculated this by taking 11 over this 100, which would have given him or her 11%. So this one here, if you get a crazy examiner, this is what the examiner will do. He can't give you directly. Earnings yield. But even when students are given earnings yield directly, over 60% of the students will not get even the correct answer. So Mohammed is giving me there 17, 48, 250 as the value of Zora. as the value of Zora. So have we been able to learn something here, ladies and gentlemen, that you guys can carry to your exams? Have you been able to learn something here? Have you been able to learn something here? Great, great. Earnings yield method. Earnings yield method, very, very important. The next part wants me to get WACC. I'm not teaching WACC today. I normally like teaching WACC and WMCC at the end of the topic. At the end of the topic, after I've been able to inject many things, like for example, having taught you how do we get cost of redeemable debentures, like here, there are redeemable debentures. How do we get cost of redeemable preference shares? After I do all that, then I'll be able to come and now show you how do we compute WACC, how do we compute WMCC, this cost of the extra coin we raise outside here. So with your permission, I'll be able to take on another valuation question. Another valuation question. Like last semester, they gave us a very easy valuation question. Very easy, really. If you look at the question they gave us last semester, I never expected to get any student failing in this particular question. You know, at times we really go ahead to give students very easy questions, but unfortunately, they still end up failing. But again, you can't blame students because, you know, students, they have quite a lot happening. Some of them are parents. Some of them are parents. Yeah, this is the question they gave us last semester. That's August 2025. Question number 5, dog. August 2025, question number 5, dog. It was a very easy question. Very easy question, really. Very easy question. Very easy question. So it's August 2025, question number 5, dog. So we are told here, my students, the Alliance Fund is a mutual fund that holds long-term positions in a small number of non-dividend paying stocks. The holdings at the end of the 2 years are as follows. So you can see year 23, this is quite an aggressive fund. It has got very many stocks. Yeah, very many stocks. Year 2024, very many stocks. Then you can see in 2023, they've got this cash and they also have some expenses there. 2024, the same. At the end of each year, the Alliance Fund had 186,000 shares outstanding. Required, they wanted us to give them the net asset value of a share of Alliance Fund at the end of 2023 and the year 2024, including cash position in the total portfolio value. Yeah, so the growth rate in the net asset value, and you can see here we are really guiding you. Ladies and gentlemen, please, if you are my student, whenever you go to an exam and then you realize that you're not even able to understand things that are being asked, there are simple basics that we expect you to be knowing. That whenever you see number of shares and then you see a price, yeah, a price per share, what shall you always be doing? Whenever you see number of shares and you're seeing price per share, even if you understand nothing in finance, what shall you always do? Whenever you see number of shares and you're seeing price here per share, what shall you always do? You multiply to get total market value. You multiply to get total market value. So then we do for the year 2023. Let's do for the year 2023. Yeah, so for 2023, ladies and gentlemen, I can see number of shares and I can see price. And we have our stocks there, A, B, C, D, E, F, G, H, I, J, K, L, M. No, if I write it that way, my board will not be enough. I don't think so. Let me see. If I write it like that, no, let me just. So we have here 2023. Yeah. So we have number of shares, we have price, we have market value. So we have here A, B, C, D, E, F, G, H, I, J, K, L, M. Yeah. So we copy all this. Select number of shares. Yeah, so we have 20,000, 45,000, 75,000, 23,000, 3,800, 35,000, 42,400. We have 55,000. We have 90,000. Then we have 18,000. 17,400. 27,400. And then we have a 0. 17.75. 19.88. 42.13. 71.25. 9.63. 15.25. 32. 63. 56.5. 87.13. 14.5. 25.38. And then lastly, we have 45.25. So go ahead and multiply. You take number of shares times price. Number of shares times price. To get market value, if, for example, today you have 10 shares from Safaricom, and each Safaricom share, for example, is going for 30 bob. So in terms of your valuation, yeah, the value that you have there, then you will take number of shares times market price per share. So can you kindly give me like the first one, 20,000 times 45.25? Yeah, so Nancy gives me 905,000. Thank you so much. Thank you so much. Mohammed, yeah, great. So we pick on the second one, and I'll be very patient. We must get all of them. Yeah, 114, 2100. So 114, 2100. $10,87,500. 10,87,500. 10,87,500. $200, 39.90. 239.90. 17,4,200. Thank you so much. What are we doing? We're taking number of shares times price. Share price, 22,05,000. Thank you so much. 22,05,000. Thank you so much. So we have here 13, 56,800, 6,800. Mm-hmm. 83, 83, 8750. We are doing very well. We are doing very well. We are doing very well. Mm-hmm. So we have 866, 700. $12.82, 500. $733, 733, 062. Thank you so much. Sorry for this. I know it's very involving, but very easy. So 544, 544, 712. The last one is 0. So no, then what is the total share value? Total share value. Total share value, add everything. You add everything. So we have a ninja giving us a value of what here? A value of 14,706, 314, 14, Sylvia, 14,706. Yeah, 14,706. So we have here 14, 706, 14,706, 314, 314, 14,706, 314. Now, ladies and gentlemen, having gotten that, then I would want us to get the total value of our portfolio for 2023. Remember, they have to, you know, this is basically what you have invested in the shares. This is what you have invested in the shares. You also have some cash position. You have some cash position. You have some cash position. Yeah. Remember, they wanted us basically to give them, ladies and gentlemen, yeah, including cash position in the total portfolio value. So you can see our portfolios in terms of shares there, but we also have some cash position. We have cash of 708,400, 708,400, 708,400. And then, of course, we have expenses for the same year. Yeah, expenses for the same year of 146, 146,000. So expenses you subtract, right? You subtract expenses. So in this case here, then we should be able to get whatever you'll get there will be your total net asset value. Total net asset value. Yeah, remember these are mutual fund. For mutual fund, we are looking at how much have we invested in the various shares, how much are we still withholding in form of cash, and what is our total expenditure, all right? Then remember, when I started, I told you that NAV is total assets minus total liabilities, including preference. And this one here automatically translates to equity. So meaning that net asset value will as well be your equity. And your equity, it is these investments that you have in form of what? In form of shares. Yeah. And then of course we have some cash left in the box. It's an asset. You add it. And then you subtract any expenditure. You subtract any expenditure. So in this case here, after they subtracted, what figure are they able to give us? Yeah, remember you are taking this 1470, 63, 14 plus 708, 8400 minus 146,000. I can see Nancy's figure. I'm just waiting for someone else to confirm this. So they're getting 152. They're getting 152. They're getting 152, 68, 714, like that. And then give us the net asset value per share. Per share. Do we have number of shares, ladies and gentlemen, outstanding in total? What have they told us to be the number of shares outstanding in total? Please. Are you able to see the number of shares? And they're not going to change in between the years. This was quite an easy question. They're not changing in between the years. So we have here at the end of each year, the Alliance Fund has 1086,000 outstanding shares. So divide this by 10. 68,714 divided by 10, 86,000. Then you're able to get the net asset value per share. 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 Which is going to give us what amount? 14 point what year? We are getting 14.06. I'm being given a figure of 14.06. NAV per share is 14.06, like that. So I want to believe that for 2024, you guys will be able to use now the same approach to give me the figure for 2024. Assuming for 2024, I'm assuming for 2024, you get a net asset value per share of say 16.3. I'm just assuming. Then Roman 2, they wanted us to give them the growth rate. The growth rate of NAV per share. Very easy question. Growth rate of NAV per share. If you look at Roman 2, if you want to see, let me just project the screen. Yeah. So they want us to give them the growth rate in the net asset what year? Value. So how do we get this growth rate? Assuming this is what you guys shall get for 2024. So remember growth rate, I will just take the new figure minus the old. Divided by what year? Divided by old. Times 100. Times 100. So the new, of course, will be the 2024, the one that I've assumed here. So assuming this is 16.3, you say minus the older figure is the 2023. Yeah. And then you come and divide this by what year? By the old figure of 14.06. Yeah, times 100. Because they simply want to know, how is this NAV growing? How is this NAV growing? That's what they want to know. So anytime they want you to give them this growth rate, yeah, take the newer figure minus the older figure, divided by the older figure, times 100. Then you'll be sorted out. So, ladies and gentlemen, what have you learned out of this question? What have you learned out of this question in terms of valuation of a mutual fund, of a money market fund? What have you learned out of this question? What have you learned out of this question? Yes. What have you learned out of this question? I would want to hear from you, my great students. What have we learned from this question? I have one key takeaway myself, that in finance, whenever I see number of shares and I see price per share, always do what here? You shall always multiply. That's very, very key. And then once you get the total market value, remember that's your portfolio value. But they also wanted you to include the cash. There's some cash position held. Yeah. And then, of course, you subtract expenses to get your net asset value. And then, of course, you divide by a number of shares. Yeah. Once in this case here you are at home with that, then we are good to go. We are good to go. We are good to go. Yeah. Are you asking a question? 1086,000 H. This is given in the question. Yeah, you're given here. At the end of each year, the Alliance Fund had 1086,000 shares outstanding. So to get NAV, you'll take the total value of your portfolio, you divide by that 1086,000. But the most important thing, like any student who was able to even multiply like this, I mean, they ended up getting so many marks without knowing what they are doing, That is the most important thing. All right. Yeah, 10, this was an example. I believe 10 later on you will be able to do for 2024. The same concept. You simply multiply 2024. Yeah, you add the cash of 2024, you subtract the expense of 2024, and then you get a figure divided by 1086,000. And then, of course, that is the figure you'll be able to use to calculate growth rate. Is that okay? Great.